wondering if you should itemize your deductions or not? Let's see if itemizing your deductions makes sense for you. When you itemize your deductions on your tax return, it reduces your taxable income by the sum of your qualified deductions. These include deductions for mortgage interest, state and local taxes, student loan interest, gifts to charity, and medical expenses, among others. If you choose not to itemize, your taxable income will be reduced by a fixed amount based on your filing status. This fixed amount is called the standard deduction. So how do you figure out which one you should do? First, add up all the deductions that you think you may qualify for. If the sum of your deductions is greater than the standard deduction for your filing status, then you may want to consider itemizing. To do that, you'll need to complete a Schedule A form along with your 1040 form. The Schedule A has 6 categories of expenses. Number 1. Medical and dental. The IRS allows you to deduct qualified medical expenses that exceed a certain percentage of your adjusted gross income. In general, qualified medical expenses include preventative care, treatment, surgeries, visits to a psychologist or a psychiatrist, dental and vision care, and prescription medications. Expenses that were paid for by your insurance company are not typically deductible. Number 2. Taxes. Taxpayers can deduct the amount they pay in state or local taxes up to a certain limit. These taxes may include income tax, sales tax, and property tax. Number 3. Interest. There are many types of tax-deductible interest, including mortgage interest, home equity interest, student loan interest, and interest in some business loans. Keep in mind that home equity interest is only tax-deductible if the home equity loan was used for home improvements. If it was used for anything else, such as paying down credit card debt, it is not deductible. Number 4. Gifts to charity. Donations to a 501c3 charity are tax-deductible. This does not include political campaign contributions. This deduction is limited to a certain percentage of your adjusted gross income. Check the IRS's website for current rules. Number 5. Casualty and theft loss. The Tax Cuts and Jobs Act eliminated the tax deductions for most casualty and theft loss. However, you may still be able to take a deduction for qualified disaster-related personnel casualty losses. In order to be a qualified disaster, the area must be officially declared a disaster area by the President. Number 6. Other miscellaneous expenses. You may have other expenses that are tax-deductible, such as qualified educational expenses and business use of your home. Check with a tax professional to see which ones you may qualify for. If you have qualified deductions that add up to approximately the amount of the standard deduction, you may want to consider itemizing your tax return. Even if you choose not to itemize your federal tax return, it may still be beneficial to itemize your state deduction. For more information on itemizing your tax deductions, visit roguecu.org/learn or contact a tax professional.